Okay, dear students, this is Mustafa Mirchawala from Mirchawalas of Accountancy, your FR trainer, and today we are going to discuss one more class regarding the pre-mock June 2025 MCQs. Okay, and this class will be good for later periods as well. You can watch for later periods if you are watching in a later period. Still, it is applicable, right? Okay, now again for your motivation, I have posted some of my recent results. You can see the scores 90s, 80s, 70s. So these are all students who followed my advice and they've watched the lectures and see you can see the results. Okay, so be confident. This is for your motivation. 100 plus results in front of you. Okay, so without wasting any time, let's move on to the question. The question number one is basically IAS2 inventories, and you know the famous rule, inventory should be recorded at lower of cost or NRV, cost and NRV. Okay, so at 31st December X9, Brighty company has a bespoke machine, special machine in the inventory that was manufactured to cater one of their clients' unique needs. The original cost is 500,000. Now, first thing, you will keep cost at one place. Cost is 500,000. Okay. On the other hand, you will write NRV. NRV is selling price less cost to sell or complete. Cost to sell or complete. Okay. Right now, what they are saying, the selling price of this machine has been agreed at 520,000. Agreed. However, due to the recent enactment of the safety regulations, modifications must be made. This is necessary. Must be made to this machine at an additional cost of 80,000. That means cost to complete is 80,000. Cost to complete is 80,000 before it can be sold. The client has agreed to pay 40% of these additional modification costs means of an increase in selling price. Now, so 80,000 multiplied by 40%, client will give us extra revenue. So 32,000 is the extra selling price. 32,000 is the extra selling price we'll receive. Now, what was the original selling price? Original selling price was 520. Sorry. Yes, original selling price was 520 and additional 32,000 we will also get. So first of all, your revised selling price is 520 plus 32. Revised selling price is 520,000 plus 32,000. So it will be, wait, 520,000 plus 32 is 552,000 is your revised selling price less cost to complete. Now there will be a complete cost to complete of 80,000. It is written without this cost, without this 80,000 cost, you cannot sell it. So it will be 520 plus 32 is your revised selling price, which is 552 less cost to complete is 80,000. Now please check it out. 552 minus 80 is 472. Okay, now simply apply IS2. IS2 clearly says inventory should be recorded at lower of cost or NRV, lower of cost and NRV. So here you will record it NRV. NRV is lower. NRV is lower. Okay, so 472,000 is your answer. 472,000 is your answer. So your first question is done. Giving you 30 seconds to read it. Question number 2 again is very easy scoring marks, very simple scoring marks. Alpha company purchased a new machinery on 1st July 2003. Keep this date in mind. For $10 million, this is the cost and life is 10 years. Okay. The acquisition was partly funded by 3 million government grant received on the same date. So we received a government grant of 3 million, and whenever we received government grant, we make simple entry bank debit and deferred income credit. Okay, so on 1st July X3 we made the entry bank debit 3 million and deferred income credit 3 million. So initially our deferred income was 3 million. Okay, now 1st July X3 to 30th June X4, this is the first year. and then you will have a second year, that is 30th June x5. Now as you all know that grant will be amortized in such a way, it will follow the pattern of asset. So asset, you can see asset has a useful life of how many years? Asset has a useful life of how many years? It's 10 years. So grant will also be amortized over 10 years. Okay, so it will be 3 amortization of grant will be 3 divided by 10 years. So per year it will be 0.3 per annum. Now don't sleep, 0.3 per annum. So in this first year 0.3 will be amortized. So we'll make the entry deferred income debit and P&L credit. So now 0.3 is already transferred to P&L. So 3 minus 0.3, your total liability, I repeat, your total liability is 2.7 at the year end. Your total deferred income is 2.7. okay, right? Now we have to show the breakup of current non-current. So next year 0.3 will again amortize. So we can do like this. Listen, out of this 2.7, 0.3 will be amortized, so 2.4 will be left here. Okay, so first of all, if somebody asks me what is the total deferred income liability at 30th June x4, what is the total deferred income liability at 30th June x4, my answer will be 2.7. But if somebody asks me the breakup of this 2.7, definitely 0.3 is going to be current and remaining 2.4 is non-current. Okay, right? So it's easy thing, you have done this in class as well. Okay, so it is B2B. See this. See the question. They are asking about 30th June x4. So your life, but they are asking which two of the values at the grant and asset. Yes, they are asking about the asset as well. So can you tell me, your asset cost 10 million, the cost of the asset was 10 million, cost is 10 divided by, if you want to calculate depreciation, 10 upon 10 is 1, 10 years is 1 million. So out of 10, if you depreciate 1, your NBV will be 9 million. Your NBV will be 9 million at 30th June. I am talking about asset now. I am talking about asset, non-current asset NBV at 30th June x4. Non-current asset NBV at 30th June x4 is 9 million. Very simple. 10 minus 1. 1 is the depreciation. So this is the B and C. B and C is the correct answer at 30th June x4. B and C is the correct answer at 30th June x4. Okay, now question number 3. It's IS 16 and 37, combination of 16 and 37. I hope you remember one topic, complex asset, and the second topic is compulsory disposal cost. Hope you remember both of them. Listen, first of all, complex asset is an asset which has different components having different useful life. Different components having different useful life. Kentucky purchased the locomotive train on 1st July x3. The date is very important. I always say date. This is the buying date. The purchase price of the train was 975,000. Okay. The locomotive engine needs to be dismantled. Compulsory disposal cost. Okay. at the end of life of 7 years, after 7 years. At 1st July X3, the cost of dismantling are estimated to be 150,000 at the end of the life. So you need to calculate present value of this. You see, after, right now we are at year 0, so after 7 years, the cost will be, see, they are saying are estimated to be 150,000 at the end of the life. So this 150,000 will be incurred at year 7. So you need to calculate present value of this. And we'll do it, not a big issue. Now, the components of the train include seats. Now this is the complex asset transaction. Seats of the train, which is 15% of the purchase price. Exterior is 45%. And yes, locomotive engine. Our topic is locomotive. That is 40% of the purchase price. Be careful. The discount rate is 6%. Yes, they are asking for discounting as well. What is the depreciation charge of only locomotive engine? Not complete. Only locomotive engine. In the statement of profit and loss for the year ended 31st December X3, very lot of dodge, this is the question of mixture. See, your buying date is 1st July X3, and your accounting period end is 31st December X3, just after 6 months. Just after 6 months of the accounting date. That means this time you need to book only 6 months depreciation. Now, be strong, stay strong, and focus on the class. First of all, calculate the present value of this compulsory disposal cost. This is 150,000. Divide by 6% means 1.06 power 7. 150,000 divided by 1.06 power 7. This is going to be 99759. Okay, so this thing will be capitalized. This 99759 will be capitalized. If you want to make the entry, let me tell you the entry: PPE debit, property plant and equipment debit, and provision credit. So this is part of your asset. Okay, this thing. Now, out of the complete total asset, the purchase price of total asset was 975. The purchase price of total asset is 975. How much is the locomotive engine? Locomotive engine is 40% of the purchase price. Okay, so wait. Is equal to 390. Okay, so 390,000 is the pure price of locomotive engine. 390,000 is the pure price of locomotive engine. Okay, so 390,000 is the pure price of locomotive engine, right? And there is a compulsory disposal cost which we capitalize. Is 99759. So $4,89759 is your total asset cost. Now, what is the life of the asset? 7 years. 7 years for this locomotive engine. See, 7 years for the locomotive engine. So your depreciation we need for 6 months only. For 6 months, okay? It will be 4,89759 divided by 7 years. It will be per annum. This answer will be per annum into 6 upon 9. That's it. 6 upon 12, sorry. $34,983. This is the 6 month depreciation. What they are asking? They are asking this. Yes, this D. 6 months depreciation is only 34893. That's it. That's it. 6 months depreciation only they want. They want only 6 months depreciation. Complete question in front of you on the screen. You can see. They only want 6 months depreciation. Why? Because we bought the asset on 1st July X3 and your year end is 31st December X3. Three questions we have done. Now question number 4, ready question. IFRS 13. Although for FR level, F7 level, it's a small standard, but yes, for the SBR level, it's one of the most important standard. So in order to calculate fair value, I hope you remember my lectures. In order to calculate fair value, you need to go to the market, and the first market, normally the first market is principal market. Principal market means the market with highest number of transactions, biggest volume. So see the total volume, see this column, total volume 400, 500 and 450. Which market has the highest level of sales, highest level of volume, number of transactions? So this is your market. This is your market. Okay, now you have selected the market. Once you have selected the market, now don't look at other markets. Now only you need to see Birmingham. Now don't look at Manchester and London. Only Birmingham is your market now. Now how to calculate fair value? Selling price less transport cost. Okay. Remember, never ever include transaction costs, because transaction is normally designed by entity. Listen to me, let me give you logic. Transaction is normally designed by the entity. So transaction cost is an entity based factor, and we all know IFRS 13 has strictly told us that do not use entity based factor, only market based factor. Now after the launching of IFRS 13, fair value is a market based thing. Okay, right? So your selling price is 3500. This is the selling price, and this is your transport cost. This transaction cost is irrelevant. Okay, so 3500 minus 100 will give you 3400, and your answer is B. Your answer is B. Your answer is B. Okay, but for this you must know this standard. For this you must know this standard. Now next thing, question number 5. This is very simple. Ratio analysis. Okay, the operating profit margin of Spring company has dropped from 20% to 16%. Now very good, very easy. Operating profit margin, in other words, your operating profit is going down, and once your operating profit is going down, the reason is your cost is going up. The reason is your cost, any cost, your cost of sales or any cost, whatever come above the PBIT, if there any increase in those costs, that will be your answer. Okay, but yes, interest will come after PBIT. Interest expense comes after PBIT, so interest expense won't be your answer in this question. Okay, be careful. Which two? We need to pick two answers now. Which two of the factors could have led to this decrease? Okay, so when our operating profit is going down, that means our operating cost is going up. Be careful. Spring company's debt financing provide increase. No, this is not the answer, because interest, finance cost or interest expense comes after PBIT, and right now they are asking about PBIT. Operating profit means PBIT. Okay, after conducting a review of its tangible assets, Spring decided to reduce the useful lives of its machine. Yes, whenever we reduce the useful life, listen, think over it. Whenever we reduce the future useful life, when useful life goes down, your depreciation expense goes up. And once your depreciation expense goes up, your operating profit goes down. So yes, this is the answer. This is the answer. It will increase your future cost. It has increased your cost. Spring company was able to negotiate better deals and obtain better price deduction on. No, this is not the answer. This is good for company. See point number C. Point number C says that we are buying goods at a very low price, so that means our cost is going down, and once your cost goes down, your profit goes up. So this is not your answer. Now D, spring company increase the wages of manage. Yes, this is, that means your cost is going up. Your cost is, openly they are saying your cost is going up, and whenever your cost goes up, your profit goes down. So B and D is your answer, and this is ready question. This is easy peasy, easy peasy, clear marks. On 1st April X5, Iringa company made an investment in the ordinary shares of Brown company, paying $10 million for the shares, an additional 1 million in broker fees. Okay, right? So we bought shares for 10 million, go very slow, and then we paid the transaction cost, this broker fees, transaction cost. The shareholding was less than 2%, so it's a trade investment. IFRS 9 will apply. Trade investment, IFRS 9 will apply. IFRS 9. And hope you remember, in IFRS 9, whenever you buy shares, in IFRS 9, whenever you buy shares, there are two categories: fair value through OCI and fair value through PNL. Fair value through OCI and fair value through PNL. Now let's see which category they are referring to. Iringa company made the irrevocable election to classify the investment as fair value through other comprehensive income at the recognition date. Very easy. Yes, now as the category is fair value through OCI, so this cost will also be capitalized. This 1 million will also be capitalized. Okay, so 10 plus 1, at the date of acquisition of shares, we recorded the investment at 11. We recorded the investment at 11. Now don't sleep. At 31st December X5, the fair value was 12 million. So definitely, listen, 31st December X5, we must have brought asset to 12 million. We must have brought this investment to 12 million from 11 to 12, 11 to 12, and this unrealized gain of fair value through OCI goes in OCIs. Okay, so 1 million we have transferred to OCI, and now our asset is at 12 million. Now our investment is at 12 million. Be careful now. And it was correctly accounted for. Now at 30th June X6, mid of the year, mid of the next year, 30th June X6, company sold the entire investment at a cash consideration of 13 million. Now this year June X6, listen, let me make the entry for you. Very simple entry. We sold all the investment for 13, so bank debit 13. We just have to calculate final gain or loss on disposal. Now the last value on which this asset was recorded was 12 million. Now the last value on which this asset was recorded was 12 million. So we'll say bye bye to our investment. Investment will be credited by 12. And yes, the final gain always goes in PNL. So 1 million gain will go in PNL. 1 million gain will go in PNL. Okay, so they are asking calculate the gain on investment to be recognized in Iringa's statement of profit and loss. That is basically profit and loss. We write it the complete name, profit or loss or other comprehensive income, but in reality it's PNL. Okay, so always remember the final gain, the last gain goes in the PNL. So the last gain in this question is 1 million. The last gain in this question is 1 million. Nothing difficult, just your involvement is needed. Okay, okay, now the next thing is question number 7. Question number 7. Question number 7. On 1st July X7, H company acquired commercial property through a 10-year lease. Okay. And now, after the introduction of IFRS 16, all leases of more than 1 year, it's finance lease. Very simple, finance lease. So lessee books we have and finance lease. On 1st July X7, the initial lease payment is 8 million. So this is what we called first payment now. Remember, I taught you this first payment now. First payment now. And you know that first payment now is treated as pure decrease in lease obligation. So annual lease payment every year, at the end of every year, we'll be paying 16 million. See, annual lease payment are due on 30th June. That means on the last day. On the last day, not the next day. Last day of every year. The implicit rate is 6%. Excellent. The present value of lease payment on 1st July X7 before the initial was 100 million. So this will be your initial entry of ROU. This will be your initial entry of ROU. Now, the most important thing, read the requirement. Read the requirement carefully. What would be the finance cost? Only they want finance cost. In respect of the property lease in H company's statement of profit and loss for the year ended 30th June X9. For the year ended 30th June X9. Listen. First of all, this is your accounting period first and this is second. This is 1st July X7. Wait. 1st July X8. And this is 30th June X9. So they want the interest expense of second year. They want interest expense of second year, not first year. Now wait. Initially, you'll make the entry ROU debit. It's, I think, 100 million. 100 million. ROU debit 100 million. Let's make it 100,000. And lease obligation credit 100,000. Okay. Still, I am not writing 30. 100 million means many zeros. So ROU debit, lease obligation credit. Now they are saying they paid first payment now. First payment immediately now of how much? 8 million. First payment, stay strong. So this will be lease obligation debit 8,000 and cash or bank credit 8,000. So that means you have studied. That means your lease amortization schedule, your LAS, will start with 92,000. Okay. So hope you remember date, rentals, finance charge, decrease in obligation, then you have balance obligation. Okay. Now listen. First of all, 1st July X7, you will be starting it with 92,000. Okay. Now at 30th June X8, the first rentals you will pay off 16,000 will be your first rental. Yes, 16 million. And now 92,000 multiplied by 6%. This is 6%. Okay, interest rate is 6%. 92,000 multiplied by 6% will give you 5520. Okay, take the difference. 10480 is your decrease in obligation. 81520. This is the first year. We have done only for first year. Now go for second year. In the second year means 30th June X9. Again you will pay 16,000. Now for the whole second year, this is your outstanding loan. This is your outstanding loan. This. So 81520 multiplied by 6%. This is your answer. 4891. 4891. That's it. No, don't. In MCQs you are not required to do extra efforts. This is your answer. 4891. This is the finance cost of second year. This is the finance cost of second year. Now be active. This is the finance cost of second year. Okay. Four eight nine one point two means 4891 200. Four eight nine one 200. Okay, now next one. Listen. On 1st May, on okay. So your next question is question number 8, and that question is about reverse working of consolidation. Reverse working of consolidation. Reverse working of consolidation, that is linked to reverse working of consolidation. Normally you have seen, it's very easy question, not a difficult one. Listen, normally you start forward working like COI, cost of investment, add fair value of NCI at acquisition less fair value of net asset of S company, you get goodwill. Now first let me write the format, then it will be easier for you. Listen, first you do COI. In COI, in this question there is one cash consideration. Very easy question, just give this message to your mind. Cash consideration, then you have contingent consideration. Okay, then you have fair value of NCI at acquisition, remember? Okay, this. Now finally you will deduct less fair value of net assets of S company. From this, normally you have ordinary share capital and retain earning, sometimes share premium as well. You will deduct the total, you will get goodwill. Okay, now how you will do this question, they will give you this goodwill as well. Listen, this thing will also be given, so you'll first calculate this, then this thing is given, finally you will calculate this cash consideration. Total reverse working in this question. Okay, so be active, nothing is difficult, but dates, because it's a topic of mid-year or part-year acquisition. It is a topic of, I think, mid-year or part-year acquisition. Okay, so first of all, you bought 70 on 1st May X5. This date is very important. 1st May X5, don't forget. 75% of the ordinary share capital of Sapphire. Sapphire is the subsidiary. Through initial cash payment and agreement to pay a contingent consideration to the shareholders of Sapphire. You know, nowadays the latest IFRS 3 says contingent consideration must be recorded at its fair value. So the fair value of the contingent consideration is 350,000. Let me write here. See, 350,000 is the fair value of contingent consideration. First thing I have put. Then Diamond calculates the fair value of NCI at the acquisition was 150. Excellent. Fair value of NCI at acquisition is 150. This thing is also given. And then the goodwill has also calculated 400. Final goodwill is 400,000. Let me put the numbers. Okay, so I have put many numbers. Now acquisition date, equity package, ordinary share capital is perfect, but retain earning they have given you on 1st January X5. They have given you retain earning of 1st of January X5. This is your retain earning. Okay, that is 350. Now but your acquisition date is 1st May. See, 1st May X5, that means January, Feb, March and April. So you need to add, you need to go forward from 1st January to 1st May. So you need to add 4 months profit. Now tell me, what is the profit for complete year? Is 140. So you will be doing 140 into 4 upon 12. 140 into 4 upon 12. Wait. $46.67. It's going to be 396.67. Okay, 396.67. Your retained earning at 1st May X5. Your retained earning at 1st May X5. Okay, 0.667. Let me do it complete. 0.667. Okay, 0.667. So let's do it. Your retained earning is 396.667. Your share capital is, I think, 600. Okay, so can you tell me the full packet? Plus 600, 996,667. I'm removing the points. Okay, it's going to be 996,667. Now you tell me, if I want to do reverse working, from top to bottom you need to deduct this. From top to bottom you need, now you'll add this. So plus 400, this will be 1396667. 1396667. Now finally, the sum of this and this, if you add these three you get this. If you add these three you will get this. If you add the first three you will get this. So now from this total subtract this and this. From this total, you are doing reverse working. From this total subtract the above two. So 193 minus, it will be 896,667. This is your cash consideration. Your cash consideration is 896,667. Not a difficult question. Simple reverse working question. Simple reverse working question you have. Simple reverse working question this was. Okay, answer is this, D. Check the question again if you want to. This is the question. This is the answer. Okay, then we have Walker. This is IS 37 F3 level IS 37. Hope you remember that present obligation, probable outflow, and reliable estimate. When I taught you, whenever you are being taught IS 37, and in the reliable estimate point you have two things. One is, like, we call it most likely outcome, and the other one is, I forgot the name, expected EVA, expected value analysis, and the other one is most likely outcome. Okay, so you need to apply that thing here. So Walker Companies, even you can do this question yourself. Walker Companies year end is 30th June X5. Walkers provide a 1-year warranty with each product sold during the year. Past experience indicates that no repairs are required to 80% of the goods sold. Whatever we are selling, if you multiply it with 80%, no repairs, no claims will come. 15% required minor repairs and 5% requires major repairs. Okay. The company's service manager has estimated that if minor repairs were required for all products, it will cost $120,000. Listen, $120,000 is the price for all, if all products comes back for minor repairs. But how many product will come for minor repairs? Only 15%. So 120,000 multiplied by 15% is your first cost, plus C. And if major repairs were required for all products, it will cost 1.2 million. 1.2 million means 1200,000. 1200,000 is required if everything comes back, all products. But only how many products needs major repairs? Only how many product needs major? Only 5%. So now multiply this cost by 5%. You will add these two. It's your answer. That's your warranty provision. Okay. So what should be the warranty provision? What should be the warranty provision? Please check it out. This is the answer. 78,000 is your answer. 78,000 is your answer. Now question number 10. Gillard Companies applied cost model for its investment properties for many years. Okay. Starting from 1st July X1, the company shifted to fair value model of IS 40, investment properties IS 40. Okay. Since fair values were higher than the carrying value for all investment property, a fair value gain of 40 million was recorded in the financial statement. Okay. So previously we were on cost model. Now we are on fair value model. And you know, in fair value model, upward gains directly reported in P&L. So this 40 million is your gain. This 40 million gain will go in the P&L. This 40 million gain will go in the P&L. So your profits will go up. Now your profits will go up. Okay. There is no change in life. This is useless thing because now there is no depreciation. Once you are using fair value model in IS 40, now you don't need to book any depreciation. Hope you remember this. How will this change in accounting policy impact the financial statement of for the year ended 30th June X2? For the year ended 30th June X2. See this, please. The camera is being stuck for a while. It's creating problem, but don't worry, I'll fix it. Now, first thing, both operating profit margin and gain. No. Yes, your operating profit will definitely go up, but the gearing will go down. Why? Listen, when your profit goes up, ultimately your retained earning also goes up, and retained earning is the part of equity. So whenever your equity goes up, whenever your equity goes up, your gearing goes down. Whenever your equity goes up, your gearing goes down. Wait, hope you remember the gearing special formula, debt equity ratio. You remember this formula? Debt equity ratio is also gearing. So the formula is debt divided by equity into 100. Remember, this is the formula of gearing. So if your equity goes up, that means the denominator is going up. So your debt equity ratio or gearing will go down. So the answer is your operating profit and operating margin may go up, but your gearing may go down because of this. See this. So A is not the answer. Both the profit before tax and gearing, no, profit before tax will increase. Profit before tax will definitely increase. Okay. Profit before tax will increase and the gearing, yes, this is the perfect answer. C is the perfect answer. Why? Because in IS 40, my dear student, in IS 40, so answer is C. Now, very easy question. Next one is 11. Just it will hit the definition. It is linked to the definition of fair value. Hope you have studied IFRS 13. If you have done IFRS 13, you can easily recognize which of the following terms represent the entry price at which the entity would acquire the asset. See, this is entry price. If you remember the definition of fair value, the latest definition, the word exit price is written. Go and check, go and read the book now, go and read the kit now, go and read the definition of fair value on Google now. It is clearly written, this word exit price to sell an asset. The definition of fair value says, but right now it's written entry price. So entry price means your cost. Whatever cost you are bearing right now, it's now linked to you, not linked to the market. So which of the following terms represent the entry price at which the entity would acquire the asset or incur the liability at current prices? So it's your current cost. It's your current cost. It's going to be your current cost. It's going to be your current cost. But if it was written exit price, the definition of fair value, then you will take the fair value definition. Okay, fair value option. Now, in accordance with IS 10, this is again F3 level question, F3 FA level question, FA. Every time I teach this in FA. In accordance with IS 10, events after the reporting period, which statement is correct regarding dividends declared after the reporting period but before the final? Okay. So let us say your accounting period is 31st December 2026, and this is on this date your financial statements are being approved. Okay, this is your accounting period. Now your dividends are declared after the year end. They are openly saying dividends are declared after the year end. So if it is declared after the year end, so no entry you will make in the last year. No entry of retained earning debit and dividend payable credit you will make in the last year. This entry belongs to next year. So in this last year, this year, no entry means no liability. No double entry means no liability at the year end. No liability at the year end. Okay. This is a non-adjusting event for last year. For December 2026, as I use the date, it's a pure non-adjusting event, so no need to book any liability at 31st December 2026. Now, they should be recognized a liability. No, wrong. There should not. Yes, this is perfect answer. Still read there should be considered as an adjustment. No adjustment. It's a non-adjusting. They should be no, never. This is a big crime. Dividend is ordinary dividend is never an expense. Ordinary dividend is never your expense. Ordinary dividend is never ever your expense. Never ever your expense. Then now you have EPS, earning per share. You have two types of EPS, basic EPS, diluted EPS. Basic EPS always reality based. Reality. In Urdu I used to say in my class asliyat based. Okay. So C company has issued share capital of 5 million. Okay, these are the number of shares. First of all, go for real shares. 1st September X5 company made a bonus issue of 2 new shares for every 5. 2 for 5 means 40%. It's a 40% bonus issue. That's it. And this is your real profit. Now wait. I will do diluted EPS afterwards. First I'll calculate basic EPS. First of all, let me calculate basic EPS for you. See. For basic EPS we go for real profit and real shares. Real profit and real profit is 756,000 and real shares are 5 million plus if you want to go very easy, just bonus fractions is multiplied. Bonus fraction is going to be 2 upon 5 is your bonus fraction. You know the bonus fraction is 2 upon 5 or you make it 40%. So you will multiply this 40% with the year beginning year shares. Only one event bonus issue. So bonus shares are always adjusted at the beginning of the year. So it's going to be 5 million into 2 upon 5. Wait, let me do it in more easy way. 5 million shares plus bonus shares will be 40%. Okay, so 40% is 2 million. That's it. So just from the first day of the year, your shares will be 7 million. You can do this with other methods as well. Even I taught with other methods as well, in which you used to apply break. But right now there is only one event, one real event in the whole year. Only one issue in the whole year. This is not the topic of multiple issues. I remember I taught this thing in our classes, that there are 2 issues or 3 issues in 1 year. First bonus, then right issue, first bonus, then full market price. But in this question there is only one issue, that is bonus issue. In this question There is only one issue, that is bonus issue, right? Wait. So your basic EPS will be real profits and real shares. Okay. Now I need, they are not asking to calculate basic EPS. That's why I've just made the fraction. Now for diluted EPS, you need to find the potential shares, the potential agreement in this question. Yes, there is one potential agreement, and that is convertible loan notes. Okay, so you need to calculate two things. First thing is number of shares from conversion. Okay, and the second thing is incremental after tax savings. Now wait. You know how you do this? You will close your eyes. You will close your eyes. And you will think over it. Listen, you will think that if these loan notes, in reality these loan notes will be converted into ordinary shares in future. What if they are converted at the first day of accounting period? You will get new shares. Okay, so read the conversion terms. See, for each $100 loan note, 60 shares for each $100 loan note. So can you calculate 60 divided by 100 means 60%. So conversion terms are 60%. So we have total 300,000 loan notes multiplied by 60%. So the new shares will be 180,000 shares. The new shares from conversion will be 180,000 shares. The new shares from conversion is going to be 180,000 shares. 180,000 shares. Okay, right? Now the second thing is incremental after tax savings. Now wait. What is the interest rate? 5% is the interest rate, 30% is the tax rate. Now once, just close your eyes and think, once you will convert your loan notes into shares, that means there will be no more loan notes. When there will be no more loan note, there will be no more interest expense. So your interest expense will be saved, so automatically your profit will go up. But once your profit will go up, tax department will charge tax on it. So you need to calculate incremental after tax saving. Now see, 300,000 is your loan amount, multiplied by interest rate is 5%. So 300,000 into 5%, 15,000 is the interest saved. So your profit will go up by 15,000, but tax department will charge 30%. So only 70% will come in your pocket. So what is your incremental after tax saving? This is going to be 10500. 10,500 is your incremental after tax savings. Okay, right? So two things, the two important things you have calculated. Number one is number of shares from conversion, and the second thing is incremental after tax saving. Now let's do diluted EPS. Listen, let's do diluted EPS. If you remember my lectures and if you have done properly, so diluted EPS is always calculated in the continuation of basic EPS. So basic EPS fraction is divided by 7 million shares. Okay, now plus in the denominator you will have 180,000 more shares, and in the numerator there will be a profit of 10,500. Okay, so can you calculate the diluted EPS? It's going to be 11 cents, which is 0.11. Okay, 11 cents per share. Okay, so this is the answer. right? So you can read it again. And one thing, if you want to do, first calculated basic EPS and then calculate diluted EPS, it is not anti-dilutive, it is dilutive, right? It is creating a bad impact. It is creating a bad impact, okay? So we have to show the bad picture. Hope you remember. Now the next question is again a final account and IFRS 9, okay? Insured, bad debts and uninsured. Remember the factoring thing. Remember the factoring thing. So what they are saying, on 1st December X3, Leslie company sold 2 million. Just they are using the word sold. In reality, it's not sold, right? Sold 2 million of trade receivable to Relay company. Leslie company received an immediate payment of 1.8 million under the factoring agreement. Now this is the key. See this is the key of risk and reward. Any receivables not collected after 6 months will be sold back to Leslie. This is uninsured bad debts. Uninsured. So that means risk and reward. Risk, the major thing. The risk and reward has not been transferred to the factors. The risk and reward has not been transferred to factors. So this transaction in reality is a loan. This transaction in reality is a loan. It's not sold. So what entry we should make? We should make this entry. Bank debit 1.8 million and liability. This will be treated as a liability. Okay. Okay. This is the entry of uninsured, if you remember. And you know what is the entry of insured? If it would be insured, then the entry will be bank debit 1.8. Listen, you will have to credit receivable by complete 2, and then you have a admin expense. You normally book admin expense of 0.2. This is the first entry is for insured. When it is insured, that means it is sold. When it is uninsured, that means the second thing. Okay. So right now it is uninsured. Let's see. See this. Let me enlarge it. Which of the following is correct regarding Leslie's factoring? 200,000. No, this is wrong. Admin expense should be booked when it is insured. It is not insured. The receivable should be removed. Never, because it is not sold. In reality, the risk and reward has not been transferred. So when the risk and reward has not been transferred, it's not sold. Revenue, oh, never, it's not revenue. The receipt of yes, this is correct. The receipt of 1.8 million, the receipt of 1.8 million should be treated as a loan, right? Because this is uninsured. This is purely uninsured. I'm sure you remember this. Now just one last question is left, and that is related to IFRS 3. IFRS 3, just let me recall you. There is a topic which with the name of exemption from consolidation. Listen, this is parent, this is S1 and this is S2. Okay, I hope if you have taken my classes, you must remember this, that this subsidiary one is also a parent in this case. See, parent is controlling S1 and S1 is controlling S2. So we are talking about this. Okay, so this middleman may get exemption from consolidation. If number one, it is wholly controlled. By a parent. See, that means it is 100% controlled by a parent company. Okay, and number two, this ultimate parent, the main granddad, the main parent company is preparing consolidated accounts for the whole group using IFRS. Okay, so if you meet these two primary conditions, then this middleman will be exempt from the consolidation. And yes, one more condition, this middleman must be unlisted. This middleman must be unlisted company and not in the process of listing. Okay, so this thing you have done in your book as well, and in my lectures it is also covered. Hope you remember it. Okay, so let's pick it up. Which two? They are asking two. which two of the following conditions allow a company to be exempt from consolidation according to IFRS 3 business combination? Now recall that part. The ultimate parent produces, yes, this is A. This is ultimate parent, means in Urdu we call Dada Abbu, right? Or its granddad. The subsidiary trades in a in a foreign country. It doesn't make any difference. If your subsidiary, if you are in Pakistan, your subsidiary in USA, still you have to do consolidation. No exemption for this reason, okay? Country is different, still you have to do consolidation. The company is a wholly owned subsidiary of another entity, yes, and it other owners do not object to the parent not presenting, yes, this is the condition. Its business nature, no need, no issue. No matter if parent company is dealing with bottles and subsidiaries selling shampoos, soap, anything, if the nature of the business is different, still you have to do the consolidation. This because of this point you can't get exemption. So A and C is the correct answer. You have done this in class as well. A and C is the correct answer, the conditions. See this. Even when I was teaching in my class, I taught you in this way. This we are getting exemption for this subsidiary, okay? Because this S1 is ultimately a parent company. Ultimately is a parent company of S2. Okay? So that's it for today's class. Hope you learned something. MCQ is a dodgy area, technical area, I always say. So you need to think twice before answering, okay? So if you like this class, please comment on this class and share with your friends. Thank you and take care.